All right, 4:32. I like to go live at 4:30, but that's just the way the day goes. Listen, guys, live streaming is not my profession. I'm not a professional news anchor. I just love live streaming at 4:30 because I share so much news and information. I share a lot of information. I share lessons I've learned over the years. I've been doing this. I'm in my 32nd year as a financial advisor. And I take everything that I've learned and I bring it out to you in the show. Sometimes there are things that have been like, recessed in my memory for 10 or more years. It just, for whatever situation or reason, there's something going on in the markets in personal finance or something that I want to talk to you about. We're going to talk about the 2022 playbook. It's getting an early start, meaning tech's down, industrials, financials, energy up. And we'll see if this is something that can last, what it's all about, and what maybe you might need to consider. So let's roll a quick intro, and we're going to get into it. Here we go. Hey, I'm back. Okay. You're back. I'm back. Welcome to the second live stream of 2022. Tuesday, second business day of the year. We've got a couple of things to talk about. First of all, while we're going through the show, I love hearing from you. So if you have any questions, words of wisdom, words of encouragement, experiences you want to share, you just want to say hi, hey, hit me up in the comments. That's what they're for. If you'd like to actually come on to the show, like actually join me, if you have a webcam all ready to go, or you're in a place where you're in a really good Wi-Fi spot with a smartphone, and you want to come up on the show and say hello, ask your question in person, and chat. I think that would be pretty cool. That would be a lot of fun. So let me know. Okay, send me and just let me know in the comments, and I'll get you the invitation link. So 2022. What should we be looking at? The playbook. So let's get into that then. But first, I do want to show you something real quick. Look at this news over here. Okay, let me just get these off the screen. The social media icons. Okay, global supply chain pressures may have peaked. A new index suggests. Okay, this is pretty significant because that's one of the main things behind inflation is problems, bottlenecks with global supply chain pressures. So we talk about inflation all the time. Inflation is part of the triumvirate of important things we talk about. It's interest rates, it's inflation, and it's unemployment. Those are like the big three factors that determine everything else, in the economy. The stock market, jobs, economic growth, economic suffering. Inflation is economic suffering. Inflation is like the silent killer. It's like blood pressure. You don't realize the damage it's done until a long time goes on. So let's get into this. Inflation is a problem. We all know that it's a problem because of global supply chain issues. Now you could give me all of your reasons why we have inflation, and okay, it's politics, it's Biden's fault. No, it's Trump's fault. No, it's Obama's fault. Look, we could go so far back into whose fault it is. But when the pandemic came around, all right, when the pandemic hit, we were basically a service-based economy. 70% of the economy is service-based, right? Some big number like that. And it's based on travel, it's based on leisure, it's based on dining out. Okay, that's the experiential economy. And the material part of the economy is, watches and cars and objects and cell phones and whatever, clothing, shoes, whatever clothing issues. Yes, well, shoes are part of clothing, rather. But whatever you want to put together, when in terms of material things, when the pandemic hit and the shutdowns came in, we basically couldn't go out to dinner anymore. We couldn't go on airplanes. We had to become basically from flip from 70%, 30%, 70% service. We became more than 70% product based. And the global supply chain, two things: it just wasn't ready to ramp up production to that extent. The other thing is global supply chains incorrectly shut down at the start of the pandemic because nobody was going to spend any money. The economy was going to go off a cliff, and nothing would work. The economy didn't go off a cliff because central banks, not just our central bank, the Federal Reserve, but the Bank of Japan, China, European Central Bank, Bank of England, the major global central banks passed programs and instituted policies to flood economies with money. And then we had a lot of fiscal spending, right? So it turned out that people's appetite for goods instead of services had a massive increase. I don't know if you want to say it tripled, quadrupled, quintupled. It went up a lot. And people were staying home. What were they doing? They were buying things online, or they were going to Walmart or Target or Costco because those stores stayed open. But more or less, people went from any money that people were spending on services, they flipped to buying objects. So while they're doing that, global supply chains were caught off guard, thinking that we're going to see a slowdown in spending on material things. The opposite happened, and it's still going on. And now that the world is also traveling and having more services are back, not quite to the extent they were, before the pandemic, but the spending has continued. We had a pretty strong holiday season, in spite of Omicron and in spite of a lot of the fiscal spending packages running out. It's taking time for global supply chains to catch up. But I covered the Baltic Dry Index, which is a price measurement of the cost of sending goods on freighters overseas. And I said to you that is down by 50%. I think I covered this about I'm going to say about a month ago, maybe a month and a half ago. And now you see now you see the global supply chain pressures have peaked according to a new index that the Federal Reserve put together. What I'm telling you is inflation is coming down. It's going to come down. You'll see. And the same thing with energy. There's a big boost in energy demand. There was a drop in supply because refiners, drillers, everybody shut down. Uh, and now there's demand for it. And I think I can tell you this: the energy industry in the United States is very disciplined, more so than ever. So instead of over drilling, the industry would rather see persistently high prices before the energy industry, starts spending a lot of money on drilling. Drill, baby, drill. If you remember that one from the 2008 election period, right? Who said that? Sarah Palin, right? When she was on the McCain ticket. So anyway, I have this memory. I remember these things. I see a comment out there, so I'm going to check. I see Joshua has a comment out there. I'll be right with you. So anyway, the energy sector is not drilling like mad. They don't want to. They like making money. They like a high oil price, so they could actually spend less on drilling and make more money. That is a incredible place to be for the energy industry. So why blow a bunch of dough on drilling when they could just use the oil resources that they have to keep pumping? So anyway, and the Saudis, Russians, they've OPEC and Russia, they've gotten very disciplined as well in terms of drilling. It took like 60 years to get to this point of discipline in the energy patch, but we're there. And, if you want more drilling in the United States, you've got to incentivize drillers. And how do you incentivize them when they're thinking, we're making plenty of money? So why should we spend money? If we spend money, we lower earnings. We're so profitable. Nobody wants to drill. This will bite them in the ass sooner or later, because what happens is the industry will go through a period of underinvestment. Uh, Wells run dry. The equipment they use rusts. It needs to be replaced, and we'll have another spending boom. When do we get to the point where we are oversupplied in oil? I think a lot of people thought when oil hit $80 a barrel, um, drillers would drill like crazy and flood the market with too much oil. But everyone is being so dang disciplined that it's just not happening yet. All right. So, but I do see inflation coming down because the cost of goods will, because of global. This is the international sign language for global supply chains will start getting fixed. What's not going down is labor. I have employees. I've had employees for a very long time, and I can tell you, when you give employees a raise, it is very hard to take that back unless you're getting a new employee who will start at a lower price point. But that's not happening now either, because it's hard to find help, and you've got to pay people what they're worth. My personal thing has always been pay an above market rate for labor. And this way I get really good people. I tell you, everyone I've hired, and I've owned my own business now for 16 years. I've always been able to hire good people because I've always paid an above market rate, and I've always treated people who work for me as my most valuable asset. That's what it takes. I see commercials for Amazon. Amazon pays $15. Like, wow, that's great. Wow. The reason you'll have a lot of turnover at the $15 rate is because as soon as people take a job, they need it, but they'll just start looking for higher pay. Pay people what they're worth, and you'll slow the turnover, and your business will be the better for it. That's just my own view. Not everybody shares that view. I realize it. I'm not for enforcing it. I'm just saying that it's my competitive advantage. And I'm glad other competitors of mine don't make it their competitive advantage. Otherwise, we'd all be even, as opposed to somebody having an advantage. I'm going on in a circle here, but you get what I'm saying, okay? So we talked about global supply chain pressures may have peaked. Let me pop myself up in the corner. Let's take a look at how the markets did before we get into the playbook for the year. Well, this is like a good segue into it. Dow up 214, NASDAQ down 210, and that's down 1.3%. S&P was basically flat. Gold was up a little. Oil continues to go up. That's what I've been saying the last couple of days. Last week, I said the week before last week, I took last week off. I've been saying that oil looks to go higher, and it's continuing to go higher. The 10-year Treasury, this is the big news of the day, though, 1.6, just about 1.65%. On the 10-year Treasury. That's a big deal. We have seen the biggest rise in the beginning of a year in the 10-year Treasury yield since like 2003. So that's a pretty long time already. And the VIX is up a little, but still under 17. Under 20 is the magic number. And the Russell 2000 benchmark was basically flat off 3 points. It's a non-event. So here's what's going on. The playbook has been for 2022, as far as the expectation goes, and this is very consensus. It is consensus. The playbook, as far as consensus goes, is as rates go higher, the economy strengthens. You should expect to see financials like banks do outperform relative to other sectors. This isn't like some kind of guarantee or forecast. It's just consensus of what the industry is expecting in the next year. The expectation is still that the super mega cap, large cap stocks will continue to hold up and do okay. That industrials should do well as the economy continues to get stronger. And we're getting into a cyclically strong part of the economy. We've been in a cyclically strong part of the economy, but should continue. So industrials, energy, for reasons we just spoke about. We already spoke about financials. materials, uh, all you know, what's expected to happen is more or less you should start to see probably the Dow Jones Industrial Average outperform the S&P 500 and Nasdaq, whereas in 2021, the S&P 500 outperformed by a lot the Dow and the Nasdaq. So we think that's going to switch. That's going to flip, and the rest of the stocks out there, not particularly. It's not particularly great forecast expectations for consumer staples. Consumer discretionary should continue to do well. That's the expectation. And most of tech will do okay, but there's a lid on what they can do because if rates go higher, that takes their future earnings expectations and lowers the value of those future earnings expectations, which means you're lowering the price of the stock. So as a stock's value is based in large part on what analysts think a company could earn in the future, and then figuring out what are those earnings worth in today's dollars. And if the future earnings are worth less because interest rates are higher, that means they're worth less. The future earnings are worth less in today's dollars. So these companies get marked down. The stocks, I should say, of these companies get marked down. It doesn't mean that the companies are bad. It doesn't mean the companies have done something wrong. But we're talking about, we're talking about stocks, not necessarily companies. So I just want you to be aware of how that is expected to work. So that's the playbook for 2022. I want to throw something else in there that I think is worthwhile speaking about. I've seen this. We've talked about this before. Let's talk about market performance. All right. Now we have indexes, and you cannot invest directly into an index, but you could invest into an index fund, which would track or mimic an index. Okay, just want to get that out of the way. If you're properly diversified, then I'm pretty comfortable saying none of you have outperformed the S&P 500. Now, I could tell you with my clientele, many of my clients have S&P 500 index funds as part of their asset mix. Now, before you go, if you're fully going to do is put people into an S&P 500 fund, then what do we need you for? No, that's not the point. To me, the S&P 500 index funds, they're just a tool, just like a tech fund is a tool or an individual stock is a tool. And I use the right tools to build the right portfolio to help you potentially earn an expected rate of return that's within your risk tolerance and time horizon so that you could have enough money for your financial goals. Now, what are your financial goals? How much money do you need? That's how we figure these things out. If you really want to know, it's all about doing math, figuring out what things could be worth, what your goals are, and will the math work out? And even when you think you have the math down, it doesn't mean it's going to work out in a linear fashion. There are going to be some years where you're going to be like, wow, the market's down so much, I'm not up to par. I'm not going to meet my goals. And then there are some years when the market goes up a lot and you're exceeding your level, like you are ahead of time in reaching your financial goals. I think one of the reasons why we've seen so many people leave the workforce since the Great Recession is because the stock market went up so much that people who were like borderline thinking about retiring, maybe they're 60, 65, and they look at their investment accounts and they say, wow, I have a lot more money than I expected. Why should I bother working for the next couple of years? Why should I put in a few more years of work? Take the chance with COVID, not living my life, not doing something I enjoy. I'll just retire now. And we've had a big influx of retirees. A lot of people have retired because of the stock market. I mean, obviously, if the stock market tanks, you have to wonder what kind of monkey wrench that throws into people's plans. I pretty much have a good idea what kind of monkey wrench it'll throw into people's plans, which is why we always say that once you are close to a goal, you need to start moving your money from risky / growth assets to more income generating / stable assets so that you don't have to worry so much about the market tanking. Okay. So that's a story for another day, I guess. So bottom line, though, is that we think we've got this down pretty good as far as what's going to happen in the market in 2022. Now we all know these things change, and you've got to be flexible and make your adjustments along the way. This year, so many analysts, market soothsayers are calling for interest rates to go above 2% on the 10-year rate this year. Let me rephrase that. So many are not. So many market analysts are saying, I don't think we see 2% in the 10-year treasury. Some say, well, maybe 2.25, but not much more than that. It's going to be really hard for interest rates to go up much more than that. Last year, in 2021, the call was for 2.5% yield in the 10-year. And I was one of those people making the call early last year. Obviously, it didn't happen. I changed my mind anyway. I'm willing to change my mind if I see that I'm wrong, okay? But last year, people, everyone was saying, as far as Wall Streeters, analysts were saying 2.5% on the 10-year yield. This year, they're saying we don't get 2.5%. So I think this year is the year to bet on a 2.5% 10-year treasury yield, because being contrarian, analysts are saying they don't see that happening. Last year, they saw it happening. It didn't happen. So this year, they don't see it happening. So I'll predict it does happen. So here is my second go around with saying, I think we could see a 10-year yield at 2.5%. Is it enough to shock the market, to hurt the stock market? Yeah, I definitely would think so. Plus the the Federal Reserve, the Federal Reserve has a $9 trillion balance sheet. $9 trillion. I mean, how do they get out of that? What are they going to do? Sell $2 or $3 trillion into, the open market? What's that going to do to the bond market? Send interest rates to 4 or 5%, maybe. It's a really tough situation to get out of, and it's going to take many, many years for the Federal Reserve to whittle down their balance sheet, if they could ever do it. Because if we go into another recession or another slowdown or a worse form of COVID, much worse than Omicron, much worse variant, then what do? We have to start supporting the economy again. And that's the thing. You can only do so much. At some point, you run out of ammo. So that's the story of the day. Joshua Nolette. Okay, you have a question. Hey, Mitch, is crypto the way to protect your wealth? For crypto, I'll start by saying there's diversification. Now, diversification is a strategy that you use to mitigate or to lower the risk of your portfolio. So instead of betting everything on one asset class, like just on stocks, or just on bonds, or just in real estate or commodities or crypto, what if you're wrong? What if something bad happens, and that asset class goes down right before you need the money, or it goes down and never comes back? So you diversify. So while some assets go up, some go down, but over the long term, you expect them all to do well. But at least they'll smooth out the ride while they're getting you to where you want to go. I've seen everything I could. I talk about crypto a lot here. So without getting into a buy or sell on crypto, I think if crypto is a part of your diversified strategy, and as long as owning crypto is in accordance with your risk tolerance, your time horizon, and your level of sophistication of understanding it, okay? I think crypto is a lot more sophisticated than what people give it credit for. I think. I'm not saying you're not sophisticated, Joshua. I'm not saying you're not sophisticated. I'm not saying that you're not sophisticated. All I'm saying is it's part of the mix, and maybe that'll be the best part of your portfolio and a way to protect it. What I was saying yesterday about crypto is this: the worst thing for crypto, and for gold for that matter, for inflation hedges, is a central bank that has gotten religion. Like the Federal Reserve realizes that inflation is too high. They can't just keep printing like there's like it doesn't matter, and they can do whatever they want. And all of a sudden they realize, wait a minute, we have to be disciplined. And all of a sudden they stop, printing money with quantitative easing and buying bonds. they start to raise interest rates, and they're getting religion about fighting inflation. It's the worst thing for crypto. And I think that's one of the reasons why crypto has been backing off, because ever since the Fed said that they want to start scaling back their quantitative easing, their bond buying program, and get into raising rates, it's been downhill ever since for crypto. Now, I know crypto has been this, I know crypto is used in part as a way to hedge inflation, because you can't print unlimited amounts of Bitcoin. There's a discipline there. And the more Bitcoin that is on the market, the harder it is and more expensive it is to actually mine it. So there's a finite amount. Like gold, there's a pretty finite amount to gold. The supply of gold maybe grows, 1% a year, 2% a year, globally. It's pretty low. And gold is, believe it or not, it's a rare element on this planet. So having said that, it could be part of the mix for people. I don't really think it's suitable for most people, but when you talk to somebody who is under the age of 35, I think pretty much anyone I talk to under the age of 35, let's say under the age of 40, has a stake in crypto. How much should it be in your portfolio? 5%, 10%, 20%, half? I don't know. It's up to you. I think half is a little extreme. If you have $1,000 to invest and half of it goes to crypto, $500 is not the biggest deal in the world. But if you've accumulated like $400,000 and that's the bulk of your assets, and you've got 200,000 in crypto, I do think that is a lot to have in one asset class for a $400,000 portfolio, right? So it could help. I hope that answers the question. I know you want a yes or a no. Is it a way to protect your wealth? It could be. Stocks could be a way to protect your wealth also. The idea is you want to invest and you want to get a return, not that just keeps you even with inflation, but that keeps you even ahead of inflation. Is crypto the one? It might be. It might not be. We just don't know. And I know you want like a solid yes or no, but it's just part of the mix like everything else, because you just don't know exactly what's going to happen, what's going to work, and when it's going to work. Wish I had a better answer for you, man. Anyway, I thank you all for watching, and I appreciate it greatly. Jerry, I see you out there. Thank you very much. I hope you're enjoying sunny Florida. I'm a little peanut butter and jelly. Anyway, I will speak to you guys tomorrow. Have a very, very good evening, and I wish you all good health.